There's only 2 weeks left. Don't wait until January. Make sure you do these things before December 31st. Hey guys, it's Adrian here, the Canadian in a t-shirt. And please follow these tax tips before 2026 to save you money. If you wait until January, it will be too late. Let's jump in. Top priority is the FHSA, the First Home Savings Account. It's a super tool to help Canadians buy their first home. It combines the benefits of both the TFSA and the RRSP. It's tax sheltered like the TFSA, and your contributions lower your tax bill just like the RRSP. Maxing out the FHSA is my top priority every year. Even if you can't max it out or you can't put any money in, at least open your FHSA before December 31st. Very important. Unlike the TFSA, you don't build any contribution room until you actually open an account. So open the account even with $0 and you'll gain $8,000 of contribution room for this year and next year. That's the key. As long as you open an FHSA by December 31st, that $8,000 of unused room for 2025 will be carried forward. So on January 1st, 2026, you'll have a total room of $16,000. If you wait until January to open your account, you miss out. You'll only have half the room, $8,000. Don't make this mistake. You can keep the FHSA account open for up to 15 years. Plenty of time to get ready to buy a house. So get started and open this account before December 31st. And don't worry, you don't have to max it out. Whatever you contribute will help with your taxes. Now this rule is important and it can be confusing. With the FHSA, only $8,000 of unused room can be carried forward. What that means is you can't stockpile contribution room like the TFSA. If you've never opened a TFSA, you can have up to $109,000 of room built up over the years. Watch this video for the latest number. And you can contribute that big lump sum all at once. But not with the FHSA. Only $8,000 of unused room is carried forward. You don't lose this room. Everyone has $40,000 to contribute in their lifetime, but you can't do it all at once. You can never contribute more than $16,000 into your FHSA in a single year. So the best approach is to be consistent. Try to put in $8,000 every year or as much as you can. This gives your money more time to grow tax-free. Just make sure you open your FHSA before December 31st to give yourself a head start. Watch my FHSA Explained videos for all the rules you need to know. I opened my account with QUESTRADE. Link down below to sign up with a $50 bonus. Up next, we have the RESP, the Registered Education Savings Plan. This helps you save for your child's post-secondary education. It's tax sheltered like the TFSA, but you also get free grant money from the government. Here's how it works. Whatever you put into your child's RESP, the government will match 20% of that in grants, up to $500 every year. That's free money, so take it. Here's the plan. Do your best to contribute $2,500 per child every year into the RESP. That way, you'll earn the maximum $500 of free money every year. Keep that up, and after 14 years, you'll reach the lifetime max of $7,200 of grants. Don't miss out on this free money, so it's important to make this $2,500 contribution by December 31st. If you miss a year or can't contribute the full $2,500, that's okay. You can catch up on these grants, but only 1 year at a time. Meaning, if you have unused grant money, you can double up. You would put in $5,000 into the RESP and collect up to $1,000 in grants in a single year. But this should only be done as a backup plan if you miss a year. The best approach is to put in $2,500 per child every single year and do it before December 31st. Don't wait until January. You'll miss out on that $500 and you might not get it back. There are a lot of rules to cover. Watch my RESP Explained videos, link down below. Next we have the TFSA, the most flexible account. There are no deadlines to worry about. If you don't max it out, all of your unused room gets carried forward. It doesn't really matter when you contribute, in December or January. What does matter is when you withdraw from your TFSA. That timing is very important. If you need the money and you have to withdraw from your TFSA, please do it before December 31st. Here's why. When you withdraw from your TFSA, you can't put that money back for the rest of the year. Whatever you withdraw, you regain that contribution room, but only on January 1st. Let's say I'm maxed out and I need to withdraw $2,000. For the rest of the year, my TFSA is still maxed out. I can't put in a single dollar until January. If I withdraw in December, I only have to wait a few weeks, and then on January 1st, I regain that $2,000 of room plus the $7,000 of new room that everyone gets for the new year. Instead, if I wait until January to withdraw that money, I'll need to wait an extra 12 months until next year to regain that room. Bottom line, December is the best time to withdraw from your TFSA. January is the worst. So if you need to withdraw, do it before December 31st. For the RRSP, it doesn't follow the calendar year. Instead, the RRSP calendar starts in March. So any RRSP contributions in the first 60 days of 2026, that counts against your 2025 income. This way, we gain an extra 2 months to run the numbers and reduce our tax bill. If you had a high income in 2025, contribute to your RRSP by March 2nd, 2026, and that deduction will lower your tax bill. That way, you'll receive a tax refund when you file your tax return in April. So for the RRSP, there's no rush in December. The RRSP deadline is March 2nd, 2026. For all of these deadlines I covered today, don't wait until the last minute. Deposits and withdrawals can take a few days to process, so plan ahead. To open each of these accounts, use my referral links below for a sign-up bonus. And check out my year-end tax tips video. I go into many details, including tax loss harvesting, the superficial loss rule, and more. This might be my last video for 2025. So happy holidays, and I'll see you guys next year on the Canadian in a T-shirt. Bye guys.